All right. Good morning. Good afternoon, everyone. It's morning for those of you on the West Coast, for those of you in Texas and Central Time, and the few people on the East Coast who are with us. Good afternoon. It is the day after St. Patrick's Day. There is a lot going on in the world right now. Oil prices are going through the roof. The market is reacting, and it's tax time. There's a ton of stuff going on right now. If you haven't had a chance, check out our weekly update. We did put out some good information yesterday regarding what's going on in the markets. Before we jump into the tax presentation, I just want to make sure we do take a moment and talk about if you do have questions, if you are concerned, make sure give me or Ken or Jason a call. We're happy to have a conversation and review your plan. As you all know, we are huge believers in diversification. So the headline is always going to be worse than what you're experiencing. So that's just a real quick introduction because there is a lot going on in the world right now. And oh, by the way, happy St. Patrick's Day because it was St. Patrick's Day yesterday. But let's go ahead and jump into it. So, Ken, we have a little tax brain teaser. If you don't mind, I'd like to take it because I just went through getting tickets to go see Metallica opening at the Sphere. My wife and I are going to be there for the opening shows. We have really good tickets. So I can relate to this quite a bit right now. So here we have Bill. He's retired. His taxable income, not his gross income, by the way, but his taxable income is right around 59,000. Now, some of you might be wondering, how does he get his taxable income down to 59,000? You may want to have a talk with me, Ken, or Jason to see how you can do that. But he's pulling 45,000 from his IRAs. He's got some Social Security. He pulls out an extra $1,000 to go see Metallica at the Sphere in Las Vegas in October. So how much do we think he should owe on that extra $1,000? Well, when we look at it, he goes from 58 to 59. So we're thinking 22% maybe, right? So he should owe 220 bucks. Wrong. He's going to pay $407. That is almost a 41% tax rate on that income. So you're probably wondering, how on earth did that happen? And the way it happened is it's an intersection of various tax rules that you face in retirement that you didn't have to even consider when you were in your working years. And that's what we're going to take you through today, because tax planning does change as you transition to retirement, but maybe more importantly, through the 4 stages of retirement. I'm Matt. Ken's going to be doing a lot of talking today as well. Jason Dufault will not be with us today. But before I turn it over to Ken to talk a little bit about some of the next steps here, just please be sure that you always seek professional tax guidance. We can help you with tax planning, but we cannot give tax advice. We are not enrolled agents. We are not certified public accountants. We can explain how a Roth conversion works. We can explain how taxable distributions work and those types of things. But if you really want the tax advice on, hey, what's the bill really going to be? That's where we need to pull that professional in. If you're not sure about working with a professional, or maybe you never have, it's another reason to reach out to us, because we have a great network of people you should be working with, especially for those of you who aren't sure. So, Ken, how does the tax picture change for people when they transition from work to retiring?
So, a number of things. First thing is we are pivoting from saving mode. And when you do save, you get things like deductions to spending mode. And every time you touched your dollars, unless you've done some planning in advance, it's likely a taxable event. Everything from distributing from your IRA to the capital gains that you're dealing with from your investments. Also, you lose a surprising amount of the deductions you might have been taking advantage of. Child care tax credit is gone. Likely as you're getting into or through your retirement, your mortgage is gone. So you get some of those interest deductions gone. And then also there are new taxes, right? You have your Medicare premium. If you're in, as we'll be talking about more, as your income increases, your Medicare premium increases as well. And there's additional costs like long-term care and the different medical things that'll be popping up later in life. So it's a maelstrom, and being prepared for it is the first step. And so congratulations for being here.
All right. So, Ken, what would you say is it's kind of a setup here, but what's really the first thing people need to think about?
It's not about the income that you report. It's about the income that you have, the after tax dollar amount. We were just talking through a case right now. They're California based, but understanding that taking dollars from an IRA triggers state and federal income tax, taking leaning more into Social Security income only applies to partially federal income tax. But there might be other income sources like California municipal bonds, which might be exempt from both of those. And so how do you get the net dollar amount you want is huge. So in this example, if you have $500,000, and again, only looking federally, if you're at the 22% tax bracket and you liquidated all of it, that's only 390. If you're in the 24, you liquidate all of it, you get 380. Even though you see $500,000 in your IRA, you don't have that amount. They should really put an asterisk or a question mark right next to it because it all depends on when you liquidate it and what are the tax rules at that time. One other nugget, last bullet point, is as you get older, the better your investments perform, the larger your RMDs are going to be, and they start around age 73 and 75. We'll be talking more about it, but there's actually such a thing as too much money within an IRA.
Yeah, and this gets into Ken, what you were talking about, the after-tax value of the account. A lot of you have important legacy goals, and keep in mind, legacy is not just the dollars you leave behind. It's also what do people remember about you? You know, how were you in the last 10 to 15 years of your life? Had you done planning? Were you the fun aunt, uncle, grandparent, whatever the case might be? Or were you the one who was sitting at home worried about everything all the time? So when we think about what Ken said, you see your account balances start to rise over time. If you look at the after-tax value of accounts, you can see it's a huge difference between a 0% and a 33% effective tax rate. Those of you in California, add on another 10%. Maybe it's a 43% tax rate by the time you're done. So again, you can see it's a huge, I would say, divergence in the tails on this graph because a couple percent, yeah, it matters, and it matters a lot. Okay, Ken, I'll talk about Social Security and Medicare quick. So don't forget you've got some tax traps waiting for you over here too. So remember, Bill's going to see Metallica. He's going to have his 40.7% tax rate on his $1,000 distribution. So what happened? How did it get there? Well, his IRA income before the trip, after the trip, you can see it circled. Okay, 45,000 versus 46,000, but nothing else changed. Okay, nothing else changed except for his adjusted gross income. If you look on the next slide, what you'll see is his adjusted gross income jumped because of that $1,000 distribution by about $1,900. Okay, so what does that mean? That means taxable income went up the same amount, but now his income tax changed to 8,030 versus the 7,623. So from a planning standpoint, what that meant was that extra 1,000 changed the calculation on his Social Security benefits, and he got bumped into the next higher level with Social Security. Because Social Security has basically three brackets. There's a 0% bracket, a 50% bracket, and 85% bracket. He got jumped into the 85% bracket for his Social Security benefits at the federal level. Those of you in California again, and those of you in Texas, don't worry about your Social Security benefits being taxed because they are not taxed at the state level at all. Okay, so that's the Social Security tax torpedo. But wait, and this is late night television coming at you here now. But wait, there's more, and it is Medicare. All right, Medicare has means testing. It's called IRMA, Income Related Monthly Adjustment Amount. And when you look at the example on the screen here, we have a couple that have about 342,000 in modified adjusted gross income. So we've moved on from Bill. Okay. They sell some stock, $1,000 gain. So they're thinking, hey, great, we held it long term. We're only going to pay 15%. We are also going to have to pay net investment income tax because we're over the thresholds. So to the feds, we're going to have to pay 18.8 overall. Okay. No problem. We can handle that. That should be fine. We're not worried about that. Well, here's what that $1,000 sale did. It took their modified adjusted gross income and it moved them up one bracket in the means testing for Medicare. And what that means is their monthly premiums jumped by about $122 a month per person. That's just for Part B. For Part D, it jumped by another, call it $23 a month per person. Now, here's the real kicker with this, okay? Is it an extra $3,500? Sure. Is it an extra $188 with the capital gains and all that? We're not even thinking about state income tax at this point, right? Yeah, it's a $3,700 tax bill when you factor in how it changed your Medicare premiums. Well, the real kicker with this, the real kicker on Medicare is it is a 2-year look back. So if you're familiar with Medicaid in Texas or CalAid in California, there's a 5-year look back if you're going to qualify for some of those aid programs if you need long-term care services. Okay. 5 years. Well, Medicare, which is a different service completely, has its own 2-year look back. The other thing, and especially in California, for our clients who have a lot of California municipal bonds, well, guess what? That municipal bond income, that tax-free income that you're not paying taxes on at the state or the federal level, that gets added back into that modified adjusted gross income calculation for IRMA. So you've got a lot of potential traps here, but is 2 years a long time? Yeah. You're going to forget that you sold that stock. You're going to think, yeah, we paid our taxes on that last year. And then what's going to happen in January is you're going to look at your Social Security deposit and go, wait, why did that go down? It went down because of the 2-year look back for IRMA. So when we're looking at tax planning with our clients, we're not just looking at state and federal, we're also looking at IRMA because this is something you don't even have to think about when you're working. Okay, a couple other quick points on Medicare, and I'll turn it over to Ken. When should you enroll? You've got to sign up for Part B on time. You absolutely do. If you fail to do so, you are going to pay an extra 10% penalty premium on your Medicare for the rest of your life. Okay, make sure you sign up on time. There's 3 sign-up windows. Typically starts in the fall. There is a catch-up period that runs from January through basically first quarter of the following year, but make sure you get signed up in one of those windows. If you miss it and try to sign up later, you're going to pay an extra 10%. And guess what? That IRMA stuff I just talked about, that could still apply as well. Okay, Ken, what about other tax traps?
Just a few. So you really must plan how and when you're going to be using your taxable, tax deferred, and tax-free assets to manage your income and tax brackets efficiently. When you're in the accumulation phase, again, we're primarily looking for deductions. We're filling up your bracket, what we can, but now we need to take the next step. And that, next slide.
Oh, sorry. I heard next step and I was like, oh, he's going to keep going for a little. Sorry.
Yep. So we should really consider doing Roth IRA conversions. And you really, when you think of your assets, there are 3 buckets. As I just mentioned, there's the taxable bucket. This is your checking account, your savings account, your brokerage, your real estate. Every year you're taxed on it. You get 1099s from it. You get capital gains from it every single year. Then there's your tax deferred bucket. These are your 401ks, IRAs. You put money in, and as it grows, you're not taxed on it, only on distributions. But then there's your tax advantaged bucket. It went in after taxes. It grows tax-free, but when I take distributions, it's also tax-free. Add up all your dollars in each one of those buckets, and see which percentage is in taxable, tax deferred, and tax free. Now ask yourself, where do you want most of your dollars? Well, one of the ways to take dollars from one bucket and move it to the other is through a Roth conversion. If Jill wanted to convert $100,000 to her Roth IRA, she just needs to add it to her gross income. Now she will need to pay state and federal income tax if those apply. But you run the calculation, you're in the 22% tax bracket. If you are over the age of 59 and a half, you can use your principal to pay for it. So 78,000, the remainder goes to the Roth, and then $100,000 have effectively paid taxes and is now in your Roth bucket. The other alternative is you pay the $22,000 out of your checking and savings, and now the full amount goes into your Roth. But one of the calculations we're always looking for is, all right, how do we fill up your bucket? We live in a progressive tax where only the next dollars are taxed at your current rate. And so if you are at the beginning of the 22% tax bracket, you have a fair amount of room until the 24. And then after the 24, there's like a $250,000 gap all the way until the 32. Again, we really don't want to go to the 32 because it's an extra 8% on just your federal and state income taxes without even factoring in all the other tax lines you might have tripped. But we're also thinking about that. We're looking at, when do you cross into the next IRMA bracket? What are all the different taxes we might be looking at while we're filling up this bracket? Is it worth going all the way to the top or maybe half the way there? But you want to be cognizant that you're not throwing yourself into the highest brackets. There's a few households we've met that they're converting $500,000 a year, and that's right there alone putting them into the highest brackets. To be most efficient and effective is to do it within the brackets that you're currently in.
Can I just elaborate on one or two points there?
Please.
Yeah. So we get a lot of people who retire late 50s, early 60s, because we do a lot of Social Security planning with people. And for those people, in many cases, they want to wait to take their Social Security. They're trying to make sure they get a bigger benefit later on. They've done a great job saving, which is why they can afford to retire. But the problem is most of their money is tied up in 401ks, things, 403bs, 457s from work. So one of the things you do, and Ken was basically saying this, one of the things you do is, hey, you know what? I have these low income years in my 60s because I'm waiting for Social Security. I'm waiting for maybe some other income sources to turn on later. Well, if that's the case, then all you do is, if you're going to target Roth conversions, do it now. Don't wait. Just to reiterate the point, we are in a really, believe it or not, I know it doesn't feel that way, but at the federal level, we are in the lowest tax environment from an income tax standpoint that we have been in since the 1920s. If you're thinking about Roth converting, you need to do it. I know a lot of people said, well, they just passed this permanent tax bill last year. We're going to talk about that. Not next week. I think it's the week after. But that bill, even though it says it's permanent, it just takes an act of Congress and the president sign off on it, and it's changed. That's all permanent means, is that a future Congress and a future administration can change it. So if you're seriously thinking about Roth converting as a way to manage your future tax load, you want to get on it. You don't want to wait. Sorry, Ken. I didn't mean to steal your thunder at all there.
You're great. So imagine this. You've just retired. You no longer have any income. Believe it or not, that's a good thing. When you're an employee, you're getting that W-2, you're getting that income, and it is taxed. It's exposed to FICA, all the different taxes that exist. You're paying them. But now that you are unemployed or retired, both are pretty much the same thing. You get to choose how you're going to generate the income that you need and want. So again, imagine this. You have zero income, but you have substantial cash value life insurance. You also have IRAs, and you have highly appreciated stock. Where should you take your dollars first? What if you lived that entire first year strictly off of your cash value life insurance? Assuming you all follow all the necessary provisions, how is it taxed? It's not. What tax form does it show up on? It doesn't. And so now that your income's very, very low, you can potentially sell some of your highly appreciated stock. If your adjusted gross income is below a certain threshold, Matt, pop quiz, what is the capital gains rate, assuming you're at the lowest income? Yeah, what are you paying on capital gains on your appreciated stock?
15%. You are not paying income taxes. Oh, I'm sorry,
Actually,
zero.
zero, zero. If you have qualified long-term capital gains and your income is extremely
Mhm.
low, and again, we'll talk to you if necessary, but you can get all those gains tax-free. So again, what would that look like? Also, because your income's low, might it make sense to do some of those Roth conversions in those years, as opposed to liquidating from your IRA? Now, when you liquidate from your brokerage, it's taxed at 15%. And meanwhile, your cash value life insurance is just humming along, growing tax-free, but we're not leveraging it. So food for thought. So two other pre-retiree strategies, if you qualify, is take advantage of your HSA. I know a lot of you that are coming into retirement have really only had access for the last few years, but if you are still able to contribute to it, take advantage of it. You get the tax deduction today, but then it's all the deduction today, but then it's also tax-free on the distribution. I would just advise you to be strategic on what expenses are you using it for. Yes, you can use it for your Tylenol and your NyQuil, um, and also your regular prescriptions, but there might even be ways to use it to cover some of your long-term care expenses. But let's just be strategic with it. But it is a piece on the chessboard of taxes. HSA not being utilized enough. The other one is maybe you want to start up a business. If you start up a business, and let's be honest, we'll call it a hobby, where you can generate some revenue, and technically you need to have profit every at least every 3 years to show, you can get a substantial increase on your standard deduction called the qualified business income deduction. And so again, could be very good way to have additional tax savings while you're doing something you love and enjoy. What did I miss on that, Matt?
I don't think you missed anything. So,
That's a first.
so you got me not paying attention though. So
Yes.
thank you. All
Mhm.
right. I can touch on charitable giving and tax planning. So this is something we get a lot of questions about. Folks, remember, you've got a lot of standard deductions. And over the next 3 years, you have additional deductions if you're 65 and older. So if you're thinking, hey, I'm going to give 5,000 to a charity, unless you're itemizing, it's not going to do you any good from a tax standpoint to give that 5,000. Okay. You're going to have to pull out whatever you had to pull out of the IRA or whatever it is anyways, right? To be able to give the 5,000 in the first place. Okay, so from a challenge standpoint, what do you do? Well, you do what's called a qualified charitable distribution, a QCD. So we have some clients doing this. The numbers went up. It used to be 100,000. Now it's up to 111,000 from the IRA per person, not per household, per person. But this can also be a very tax efficient way to lower some of those traditional IRA account balances without generating a tax bill for yourself. Why would I do that? Well, one, don't forget required minimum distributions, depending on your birth date, are going to kick in either 73, 75. So when the required minimum distributions start, it's a percentage on the total value. Qualified charitable distributions, if you look at the third bullet point, they count as the required minimum distribution, but they do not generate income tax, or they're not considered income, so they generate no income tax for you. Okay. You don't get a deduction, but it's not reported as income, so you don't need the deduction, right? The thing is, you got to have a legitimate charity. I'd love to do the charity of Chloe and Charlotte, which are my kids. It's not going to work, right? They got to have a tax ID number. I mean, the whole thing has to be upfront and above board. So here's what I was getting at earlier in terms of what does it really cost to give? So if I'm not doing the qualified charitable distribution, right? Basically what ends up happening is let's say you wrote a check for $5,000 to the charity. Okay. You pulled it out of the IRA. Well, that satisfies the RMD, or part of the RMD, but it's reported as taxable income. Well, okay, maybe your tax bill is going to be at that $720 number you can see on the screen in front of you. And if that's the case, what that really means is it cost you $720 to give that $5,000. Whereas with a QCD, you can just give them the 5,000. So from a planning standpoint, we really like QCDs because a lot of our clients do have sizable IRAs or 401ks or 403bs going into retirement. And when that happens, the QCD might be a good option to satisfy the RMD, but not blow up your state income, your federal income, and your Medicare premiums at the same time. Ken, go ahead.
Yeah, the other thing I'll add is you were going to give 5720 in the first place. I'd say more than half of our clients take advantage of this don't give the 5,000, they give the 5720. They were giving
Right.
to give in the first place. If you can increase your gift by 15% just
Why
because
not?
you know the rules, why wouldn't you? One other point I'd like to add is, well, I'm not 70 and a half and I'm still below my standard deduction. What could I do? Is you could bundle your gifts. So a strategy through a donor advised fund, maybe you are giving $10,000 a year. And again, that 10,000 is well below you and your partner's standard deduction, but you know you're going to give 10 grand a year for the next decade. Carve off $100,000, $50,000, enough that gets you over that threshold, put it into the DAF, get a very large deduction, reduce your income, and guess what? It might actually give you room to do some of those Roth conversions or things that we're wanting to do in our 50s and 60s and 70s as well. So even though you're not 70 and a half, QCDs are great once you reach that threshold. There are also tools you could be thinking about well in advance.
All right. Passing on assets. One thing, and I don't want to speak for Ken on this, but one thing I'd like to just reiterate, your legacy, your financial legacy is intertwined with your personal legacy. Who are you? What are you doing? How are you involved? Right. I touched on that a little earlier. But when you think about passing on from a legacy standpoint, one of the things I'd encourage everybody to think about is don't just think about what happens after you die. Try to think about what do I really want in an ideal plan? How would I want the last 5 to 10 years of my life to look, given what I've experienced and seen happen with people around me? Really put some thought into that because I know it's uncomfortable for a lot of people. Ken could tell you I was at it was right before Christmas. My kids performed for a nursing home here in San Antonio, and guys, it was a great nursing home. I'm not knocking the nursing home, but the number of people who were brought into the performing room in gurneys, in wheelchairs, um, who were not awake or didn't look like they were awake for the whole thing, right? Um, wow. I don't even want to imagine myself or my wife in that scenario, right? But I got to force myself to think, what if? How are we going to manage that? Because believe it or not, that is a huge part of your legacy as well. So, from a end of life standpoint, yes, you do need to think about transfer taxes, which are estate taxes and things like that, rules around how IRAs get inherited and so on. But also, one of the things you want to consider is what assets am I leaving behind? Because if I do planning and then the worst thing happens, right? I'm in a gurney for the last 5 years of my life, or 3 years of my life, or a year of my life, right? Have I done planning where my spouse has options to manage it, financially at least? And if I have, it can have a huge impact on how my assets are going to be left to my kids. So here's an example. Some of you have this, some of you have talked about this, right? But some of you have what are called hybrid life insurance policies, where it's a life insurance policy, but it has a long-term care or chronic care rider attached to it. Well, here's an example of someone who just using a $500,000 number as an example. has a $500,000 IRA, but also has a $500,000 life insurance policy that could be used for long-term care benefits. Well, if you end up in the long-term care scenario, the first instinct is to say, hey, I got the policy, that's what I'm going to use it for. Well, from a little tax planning perspective, you might want to do that. Something else you might want to acknowledge is that anything you're spending over 7.5% of adjusted gross income on healthcare becomes fully deductible to you. So if I'm spending $5, $10, $20, $30,000 a month on long-term care, I'm looking at some massive deductions over the last couple of years of my life. In addition to that, the person who inherits that IRA from me, they can inherit the IRA. They have 10 years to get the money out of the IRA. And when the dollars come out, whether they take it out up front or later in life or periodically during the 10-year period, every last dollar will be taxable to them. So I've got the policy with the long-term care rider. I've got some IRA money. Well, option A is use the long-term care as it did. And if I didn't spend the whole thing down, you can see the third bullet point here. There's 200,000 left over in the policy. The kids are going to get that. That's going to transfer tax-free to them. And then the IRA, hey, there's going to be IRA dollars that go over to them. What if I use the IRA to pay for it, though? Take advantage of the big tax benefits, right? Lower the taxable inheritance, preserve the tax-free inheritance. And now what happens is maybe I spent 400,000 of the IRA, so the kids are still inheriting 100,000, but now they're getting $500,000 tax-free. What this does is it gives you options. There is not a right answer to that scenario. Okay? There is not. But the options you have are what make planning work for people and work for families, because now you have good options. You're not boxed into a corner with only one way out. Okay, so we're kind of in the home stretch here. Ken, what are some of the highlights?
So if you're in pre-retirement, we've probably had this discussion, but it's worth always reminding yourself is where is your income going to be come from in the first 5 years, the next 5 years, the last 20 years of your retirement? What is our after-tax needs? And then what are the tax implications of when we're funding it? When you're in early retirement, understanding and maximizing your Social Security efficiencies and knowing when we're tripping those Medicare wires so that $1,000 trip doesn't cost you $3,000 2 years later. When you're in middle retirement, think 67 and beyond, really be thinking about and preparing for your required minimum distributions. Required minimum distributions start between 73 and 75. They're roughly 4 to 4.5%. But if your investments are growing at 10% a year, well, that means your account's growing larger and larger. That 4% starts creeping up every year you get older, which means your distributions are getting larger. And so it means more and more taxes. These are things that literally hours, call it 3 hours between 60 and 65 could save you tens, if not hundreds of thousands of dollars in unnecessary taxes that could have been avoided and planned for. I teased this before in earlier part of our conversation is there such a thing as too much money within an IRA? I personally believe there is. That number is right around $3 million. Because when you look at the Roth conversion strategy we talked about before, if you convert $300,000 a year, which is a lot, that's already putting you into the 24% bracket, if not into the next bracket. And if you have $3 million and your money's growing at 10%, that means it's growing at 300. So you're converting 300 and it's growing by 300. You're just spinning your wheels at that moment. You aren't able to dig into the principle of your assets. So you might be sitting at $1.5 million today and at 60. Well, if your investments keep growing, by the time you're 75, could easily be at that $3-4 million range. So it might feel far off, but the sooner you attack it, the easier and the better it ultimately is. Last part with late retirement is organizing your assets, figuring out your care. With the previous study we just looked at, depending on her prognosis, it might have made sense for her to take out the long-term care first to make sure that the assets last extra long. Or conversely, if her prognosis really reduced her lifespan, might make the other option uh, might make the other option more beneficial for her family. The thing is it's complicated. Things change. One little variable can make one decision more correct than the others. You've done a lot of hard work in a lifetime building up these savings, and we're here to help navigate each of those steps.
Okay, so it all comes down to planning, right? And anticipating when and how you're going to access your funds. What are the range of taxes that you're going to face? And then and this can be hard for people. I'm not going to say manage your actions. I'm going to say your relationship with money. If you're a spender going into retirement, guess what you're going to be in retirement? A spender. If you're a saver going into retirement, you're probably going to keep that saving habit going. So from a planning standpoint, one of the things you got to be really candid with yourself about is how am I going to spend in retirement? That's super important that you're comfortable in your own skin, being able to say, yep, I'm a spender. Yep, I'm a saver. What do I got to do to make sure that I'm not blowing up my retirement, regardless of where I fit in to those definitions? So when you're preparing for this, the distribution phase, like Ken talked about, is a little more complicated than the accumulation phase. So the saving is in a lot of cases, it's pretty easy, right? It comes out of your paycheck, it goes into the 401k, and you don't even have to think about it. But managing taxes happens every year, every quarter, basically every check that you're getting. And like Ken said, a mistake can be amplified in other areas that maybe you weren't thinking about when you made it. So make sure you're working with us from an education and a planning standpoint, because and it's in our mission statement, and this is something that we have built our firm around. We want to help you make informed financial decisions. That way you're confident in what you're doing and how you're living in retirement. You're not worried about it, and you're building that really positive legacy. So you're going to be remembered as the best version of yourself that people will have experienced. So we've got a good number of people on the call today. I'm going to reach out to a couple people afterwards. I know Ken will as well. Tina, I'm thinking about you. I got your postcard. I wanted to give you a little insight into what I've done with your postcard. You'll get a kick out of it. But thank you for making the time to join us. We will get this out on YouTube. Should be end of the week at the latest. Next Wednesday, we're going to talk about the Secure Act. Same time, same place. That gets more into how did distribution rules change and things like that. So that's a great second piece to this. We're going to drill a little deeper on that. The following week, which is what, the 30th, I think? No, April 1st, maybe. But the following week is the BBB. We're going to dig back into that. So, but let us know if you have any questions. Feel free to reach out. And then thanks for your time, everyone.
Yep. For existing clients, reach out to us. We can analyze your tax returns if you've already filed them, start forecasting out what this year and years beyond might look like. And if there are any opportunities to save some money in taxes or not get hit by that tax torpedo, give us a call.
Thanks, everyone.